Welcome to The Explainer. Today we're tackling a foundational concept in investing that a lot of people think they have a handle on, but actually get dangerously wrong. We're talking about surviving market volatility by moving way beyond your basic investing assumptions. If you've ever felt completely secure just because your investments are spread across dozens of different funds, well, this explainer is going to challenge exactly how safe you really are.
So let me ask you something. Is your portfolio actually diversified, or is it just crowded? It's a really common trap. You own domestic stocks, international stocks, corporate bonds, maybe a handful of mutual funds. On paper, it looks like a perfectly well-rounded mix, but as the data shows us, simply owning a bunch of different assets absolutely does not guarantee your wealth is protected when financial stress hits. A lot of the time, you're actually just buying the exact same underlying risks, just wrapped up in different packages.
Let's look at the two ends of the spectrum here. On one side, we have what analysts from Saxo Bank call naive diversification. This is your classic one-to-N strategy. You take your capital and you just divide it evenly across whatever assets are available. It's simple, sure, but it completely ignores how these assets actually interact with each other in the real world. Now, on the flip side is optimal diversification, and this is where things get really interesting. This approach is rooted in modern portfolio theory. It uses rigorous math to actively balance risk and return, intentionally seeking out asset combinations with low or negative correlations to build true structural resilience.
Here's our roadmap for today. We're going to uncover the diversification illusion, expose those hidden concentration risks, look at what happens when correlations break down, introduce the power of uncorrelated assets, demystify alternative risk premia, and finally, build out a resilient portfolio blueprint.
Section 1. The illusion of diversification. Let's dig into why basic spreading often falls apart.
The answer really comes down to this staggering number, 20%. For decades, investors have sought safety in the classic 60-40 portfolio. 60% equities, 40% bonds. But analysis from Jupiter Asset Management reveals something wild. Over the long term, that 60-40 split fails investors in 1 out of every 5 years. That's a 20% failure rate. And why is that? Well, in recent years, the correlation between equities and bonds has actually gone up. When stocks drop, bonds just aren't providing that reliable safe haven anymore, especially when interest rates are shifting dramatically.
Section 2. Exposing hidden concentration risks. Let's find those invisible fractures in your portfolio.
Think about a massive knot of interconnected ropes. When you buy different mutual funds or asset classes, you naturally assume you're holding completely independent strings. But underneath the surface, they are tightly knotted together. Research shows that concentration risk loves to hide deep in supply chains, layered fund holdings, and vendor dependencies. You might own a real estate fund, a private equity fund, and a tech ETF. Sounds diverse, right? But what if they all rely on the exact same cloud computing vendor? Or what if they're heavily sensitive to the exact same interest rate shift? If that shared macro factor takes a hit, all your supposedly diversified assets are going to drop at the exact same time.
So how do we fix this blind spot? We use a method called look-through analysis. Think of this as a literal diagnostic X-ray for your investments. Instead of just glancing at the label on the wrapper, say Global Growth Fund, look-through analysis tracks the ownership all the way down to the ultimate issuer. It breaks down those complex, nested structures until every single underlying exposure is visible. It's going to tell you if your multi-manager vehicles are actually just duplicating the exact same bets on the exact same companies. Let's walk through how you actually pull this off in practice. It takes 3 distinct steps. First, you have to obtain the full security-level holdings from each and every fund. Second, you absolutely must standardize the data using the same taxonomy for sectors and issuers, otherwise the data is just noise. And third, aggregate it. Roll up all those exposures by sector, issuer, and region. Boom! Suddenly, a totally opaque portfolio becomes a highly transparent map revealing your true risks.
Moving on to Section 3, when market correlations break down. This is the math behind market panics.
This quote from a Bank for International Settlements study cuts right to the heart of the issue. During major market events, correlations change dramatically. This right here is the fatal flaw of naive diversification. You build your portfolio assuming your assets will behave differently from one another, mostly based on historical averages. But the BIS research proves that in periods of extreme volatility, those historical relationships just vanish.
The data on this is striking. During the first half of 1998, the average correlation across 26 different global financial instruments was sitting at a very low 0.11. But when the Russian default triggered a massive market panic that August, that correlation instantly spiked to 0.37. Assets that literally had nothing to do with each other suddenly started moving in tandem. It mathematically proves that standard diversification breaks down precisely when you need it the absolute most.
Section 4. The power of uncorrelated assets. Let's talk about building actual armor for your portfolio.
To properly shield a portfolio, we need assets that truly operate on entirely different wavelengths. Uncorrelated assets are basically a superpower because they smooth out volatility without forcing you to sacrifice your expected long-term returns. And the math of scale here is fascinating. With highly correlated assets, your diversification benefits basically max out after about 5 investments. But with truly uncorrelated assets, the mathematical benefits just keep growing, even beyond 25 different assets. A prime example here is gold. Gold doesn't care about stock market earnings. It acts as a store of value that tracks inversely to central bank interest rates.
Which brings us to a really compelling new model for asset allocation. Analysis from JP Morgan, which was highlighted by Connection Capital, shows the profound impact of carving out a 30% allocation strictly for alternatives, things like private equity, hedge funds, and real estate, right alongside your traditional stocks and bonds. Think of this 30% slice as a heavy-duty structural shock absorber, because these alternatives are designed to exploit totally different market inefficiencies and private markets. They show a much lower correlation to public market panics. They fundamentally restructure your portfolio for optimized, risk-adjusted returns.
Section 5. Alternative Risk Premia Explained. Let's demystify ARP.
Alternative risk premia, or ARP, represents the potential reward you earn for taking on highly specific, non-traditional risks. So unlike just buying a stock and praying the whole market goes up, ARP strategies are often structured as long-short investments. What that means is they intentionally strip out the broader market risk, striving to be totally market neutral, and they isolate a very specific behavior or inefficiency. Because of this unique structure, they can actually generate positive carry, meaning they can make money even when standard markets are completely flat or even crashing.
Let's make this concrete with some data straight from Morgan Stanley. Here are 3 specific ARP strategies in action. First up is market-neutral rates carry. This involves going long on bonds with the highest yields while simultaneously shorting the ones with the lowest yields. Historically, this pays off incredibly well during recessions. Next is equity quality. Here, you buy the absolute most profitable companies in a sector and short the least profitable ones, which completely neutralizes the sector's overall movement. And third is FX value. This strategy capitalizes on the fact that overvalued and undervalued currencies eventually revert back to their true mean, and it's a strategy that has almost zero correlation to standard stock and bond betas.
Now, when you map these ARP strategies across different market environments, the impact is pretty undeniable. Let's say we're in a severe risk-off environment, meaning equities are just plummeting, while strategies like equity quality actually step up as a defensive counter-cyclical force, remaining positive. By holding assets that show strong earnings certainty and shorting the weak ones, ARP actively works to protect your capital exactly when traditional markets are in a freefall.
Finally, Section 6, Building a Resilient Portfolio. Let's pull this all together into an optimal blueprint.
All right, here is your actionable blueprint for achieving optimal diversification. First, you've got to move past naive spreading. Simply holding 50 different mutual funds is an illusion of safety, not reality. Second, utilize look-through analysis. Take the time to actually x-ray your holdings so you aren't sitting on hidden concentrations in a single vendor or macro factor. Third, actively carve out space for truly uncorrelated alternatives like gold or private equity that respond to entirely different economic forces. And finally, consider integrating active management strategies like alternative risk premia. These can capture absolute returns that are structurally insulated from the broader market's wild mood swings.
Which leaves us with one final, absolutely critical thought to ponder. As the data so clearly shows, correlations break down and basic diversification fails precisely when you need it the most. So when the next market shock inevitably hits, will your portfolio be relying on the blind luck of a naive strategy or the hard-coded resilience of an optimal design? The tools for true diversification are out there. It's time to start using them. Thanks for joining me on this explainer and keep learning.